Hello, I'm Julienne, and I'm here with my partner, Ian, and we'd like to welcome you all to our latest interview on the Virtual Bank Investor Conference website. Today we have with us Jay Hatfield, who's going to provide his insights on inflation and interest rates from a macro perspective and talk about bank preferred stocks, which, as we know, a lot of banks own. On average, for all publicly traded banks, around 6.5% of their securities portfolios are held in other debt securities, the majority of which is other banks' preferred stock. So be interesting to hear Jay's outlook on the valuations for that kind of security. And we'll also talk about commercial real estate.
Jay is the CEO of Infrastructure Capital Advisors and the investment advisor for the InfraCap Equity Income ETF, InfraCap's MLP ETF, their US Preferred Stock ETF, and US REIT Preferred Stock ETF. Jay's experience touches on various aspects that impacts banks. In his career, he ran a portfolio for SAC Capital. He was involved in rolling up MLPs. He ran a utility and energy hedge fund, and he started in investment banking at CIBC and Morgan Stanley. He also is very familiar with banks as he served on a board of a bank about 5 years ago, Pacific Commerce in California, which is a $500 million commercial bank. And he served on their asset liability committee. So today we're excited to get Jay's insights and perspectives. So let's turn our discussion, Jay, first to the economy. We'll take a big picture and then we'll zoom in later on. How you think the rest of the year is going to play out for inflation, interest rates? Are we going to hit a recession? I'll leave the floor to you.
Great. Thanks, Ian and Julianne, for having me on. We've had a differentiated view on the economy since the beginning of the year, and it's really driven by two insights. The first is that inflation, the best leading indication of inflation is really two indices. One is totally public, PPI, so producer price index. And the other is what we call CPI-R. You can get that on our website at www.infracapfunds.com. And all it is really the way inflation was calculated before 1982. So instead of using the BLS's flawed survey methodology, we just plug in Case-Shiller. And if you do a regression that shows, that predicts inflation in shelter 12 months in advance of what the BLS reports. So if you looked at either one of those measures, either PPI or CPI-R, in late 2020 or early 2021, as the Fed, or if the Fed had looked at it, they would have clearly raised rates because both those indices hit double-digit inflation. In other words, 1% a month. In early 2021, and they only started raising rates a year later when it actually showed up in CPI-U. So the Fed, is what we call fatally flawed. Musk calls it latency, which is a computing term, but it kind of understates that they're basically a year behind. So the numbers have been trending our direction, notwithstanding some commentary to the contrary. And if you just do this simple arithmetic on inflation, in other words, it peaked last year in May and June, and you just say, okay, what's a reasonable May and June estimate based on what happened last month? You'll see that CPI goes from last 12 months to from 4.9 to 3.5, and PPI goes from 2.6 to 0.9. And keep in mind, of those two, PPI is more important because it's a leading indicator. So we're confident that by July, almost every market participant, including the Fed, will figure out that inflation is definitely declining rapidly and that the Fed will go on full pause versus kind of, I would call them being on fake pause right now, like more like pause until we increase next. because they're just, again, focused on these lagging indicators and very incompetent, in my opinion. So that's why we're bullish. I would say one other thing on the macro side, and that is that we don't believe there's going to be recession. But again, the facts are more important than the opinion. There's a simple reason for that, is the housing inventory is at an all-time low. It's about 1.3 million units. It was 4.5 million units in the financial crisis. Normal is closer to 2 million. We also have a shortage of auto inventory, about 100,000, normally 1 million. So normally what happens, the Fed tightens, which obviously they have, and then you have mass layoffs in construction and auto manufacturing. But because of the pandemic, really, that's extremely unlikely to occur. So it's entirely, we're not going to have a booming economy, but we're projecting 0 to 1. And keep in mind, last kind of data point is during the Great Recession, 2.5 million construction workers lost their jobs. So it went from 8 million to 5.5. Right now, we're back to about 7.9 actually. But we just don't think we're going to have that decline in construction because housing will continue. A little bit less commercial building, obviously office. But keep in mind, our estimate is the infrastructure bill plus the IRA, which is mostly incentives for renewable energy construction, that should add 150 billion of the 4% of GDP. But that's a key number to watch. If we're wrong, then construction spending could start to roll over and crash and we could have layoffs. But so it's a very specific reason, because it would be perfectly reasonable to say, oh, we have an inversion. We've had 7 inversions since World War II and 7 recessions, but we haven't had any pandemics over those 7 inversions. So it's reasonable to argue that this one is different than the prior inversions.
Okay, so so near the end of Fed interest rate hikes and no recession, I think that sounds good. Maybe we can move on to talk about preferred stocks. It's a lesser understood asset class, I think, and but it's definitely had some big price moves that's affected bank marks. I just wanted to mention about the 6.5% securities held in preferred stocks by banks on their balance sheets. That's obviously split between available for sale, which is mark to market, and the held to maturity, which is not. But in this kind of market environment, everyone's marking everything to market. You can use the K's and the Q's to find the current market value. So that's why it's an important thing to be talking about, but it's hard for most people to track. So Jay, we'd love to hear your thoughts on it.
Yeah. Just one other point about the market. So preferreds have what we call a beta, or correlation to the market, of say 0.5 to 0.75. And so maybe people are concerned about the markets, but I would argue it's pretty normal in this time of year, May, June, to have some market volatility because companies aren't reporting earnings. So all you get is news, really political news, and political news is usually bad, earnings are good. So we're pretty optimistic that even the preferred market will trade a lot better when we get into July, when we have that news flow from the companies, which we think will be positive. But with regard to bank preferreds, I'll quickly get through this presentation so we can get to some more questions. Okay, I gotta make sure I can control these slides here. Oh, geez. Oh, there we go. Okay. So just a bit about our firm. We have $1 billion under management, 4 ETFs, as I mentioned, all focused on income and really what we call infrastructure. So just asset intensive businesses that we think are good credits in the long run. And I'll just have to get this a little bit more organized. There we go. So in terms of the preferred marketplace, so GSIBs, I call them money center banks, there's fewer issues because there's just a lot of regional banks, obviously. But I would say that we don't really love the designation regional because there's a big difference between US Bank Corp and the smallest regional bank to have a preferred app. So, but that does include the super regionals. But you see the par value is pretty similar. And that's really because, the companies, the money center banks are gigantic. And so if they do a preferred offering, it's going to be like for $1 billion, not 200 million. And then you can see, for obvious reasons, that the current yield is way higher for bank preferreds. I mean, for regional bank preferreds, because really as everybody knows, I guess on this call, but that, the large banks are really more benefiting from the banking crisis, and the regional banks are the ones getting hurt. And more importantly, the small regional banks, and particularly ones where hedge funds are attacking them because they look a little bit like First Republic or Silicon Valley Bank. So that's why you see this differentiated, return profile, or really income profile. And then that's also been reflected in the total return, where the regional bank preferreds are down, pretty substantially for the quarter. And then actually the bank preferreds are the money center bank preferreds are holding up quite well. And that's that dynamic, like I said, of, the deposits really moving from smaller banks to larger banks. And the, tighter regulation and sort of implied guarantee to the larger banks makes those preferreds more attractive. And then the credit ratings, you also see a differentiation as well, where most of the money center banks are A credits, or I guess all of them. They basically have to have A credits, and so that's why they haven't been impacted as much. And then with the regionals, of course, you get a much more of a dispersion on ratings. And it's worthy of note that obviously these ratings are dynamic, because First Republic was rated A, not just a month ago. So you do have some lower rated bank preferreds. And then I guess this is a bit of an advertisement. And then our fund, PFFA, we're a little more infrastructure oriented than financials. So we were 7% when the banking crisis hit. We have added financials, so we do believe in most bank preferreds. There's only a few that are still under attack, like PacWest is still controversial, but we don't own any of the smaller bank preferreds, and we didn't prior to the bank crisis. But we have been adding to those super regionals, and then also preferreds that are in the financial sector that clearly aren't going to be impacted, like mostly insurance companies, some asset managers. And we'll talk about it later, but some people are worried about insurance companies because of commercial real estate. And we think that there's some exposure, but that fear is overblown. And then the other thing to note on this slide is that you would think, oh, well, all the problem with preferreds has just been the financial preferreds, but they all trade in big indices. There's a big ETF there, but it's 75 or 65% financials. So everybody sells that ETF, and it drags down all the preferreds in the index, not just financial preferreds. So the banking crisis has been unambiguously bad for preferreds. Not horrendous. This is a pretty blown out scale. So they're down. They are down 10% from the highs. They were trading really well before the banking crisis. And that's what normally happens in preferreds, and why we are positive on them. Is that during down cycles, everybody panics, sells them way down, then things calm down, and they gradually, it's not like buying NVIDIA in the aftermarket when they beat earnings, but they gradually grind their way back to close to par at least. And we do favor, one of the other reasons we didn't hold a lot of bank preferreds is that they had a lot more interest rate risk at the beginning of last year, and we didn't want to take that risk. So in other words, they had low coupons, which have higher interest rate risk. So not all the bank preferreds are returned to par, because some of them have 4% coupons. And with rates at right now close to 4, maybe we think they'll go down to 3, but still a 4 coupon's not going to get back to 25 anytime soon. So that's just something to be aware of. Like we favor, I guess, preferreds that have higher coupons. They have more resilience to interest rate risk, and they tend to return to par faster. And so that's all the prepared slides that we had on the bank preferred side.
Okay, so just a few questions, and Ian, feel free to jump in too. So in the first quarter this year, they took a big hit in value. What's been the trend since the end of the quarter? So far in the second quarter?
It's been pretty static. It's on days where the KRE is rallying, they're up a little bit. Days like today where the market was weak, they're down a little bit. So, but they've been some recovery from the lows, but not like booming higher.
Okay, but we probably won't see any big marks one way or the other this quarter so far. And should the Fed do what you think they should, if they were looking at your proprietary index, if the Fed were to stop raising rates, maybe even cut rates, these would go up in value.
Yeah, that's a good part of the question. Like which maturity usually drives preferreds? Is there one? Is it the 5-year, the 10-year?
It's the average preferred as a duration. So they're mostly perpetual securities. There's a nuance to that, but assuming they're just perpetual for now, their duration's usually about 20 years. So that's close to what a 30-year bond is with a reasonable coupon. So 30 years, the best benchmark, pretty close to the 10, but use 30. There is a nuance though, and one reason that a lot of preferreds are very attractive and it's worthwhile digging into them individually is a lot of them are converting to floating rate. They're issued, and we're talking about $25 preferreds that trade on the stock exchange. They're issued with a call feature, but as an offset and a benefit to the purchaser, they flip the floating when they become callable after 5 years. And a lot of them are seasoned, so they're converting over the next year or two. And so like if we look at the preferreds in our fund, about another 20% of our portfolio is flipping to floating, which may not sound that great, but most of the preferreds were issued at 2.5% when Fed funds was 2.5, and now it's being bumped up to 5+. So you're getting, almost 300 basis points more of distribution. And then that does kind of shorten the duration because the higher the coupon, the lower duration. And then a lot of these companies will be, incentivized to call their preferreds at par because that coupon may not be very attractive relative to other alternatives, because of the inversion of the yield curve. So in other words, it might be better to issue 5-year bonds and take out a preferred that's yielding 8, 9, 10. So it's important to look for floating rate in this market, as they're pretty attractive.
And I think you said it, but I missed. Are most of them? No, small amount are floating.
Well, it depends on the index. It's about 35%. Okay. And then our flagship fund, PFFA, it's about 53%. So it varies. So you just have to look at every issue. There are a lot of bank preferreds that do flip. One of our biggest bank positions is a floating rate US Bancorp preferred that's got a pretty attractive yield over 7. So they definitely are out there, but you have to look at the provisions. And then there's a little bit of controversy because there's some, like there was one issue where the issuer didn't let it float because of the LIBOR SOFR transition. So it's good to look in what the index is and make sure they verify that they're going to let it float.
Okay, but even so, I get the feeling most banks own in their securities portfolio fixed rate type issues. We're still talking, they're all look relatively attractive right now, even if,
Right.
right, even if you prefer to
Yeah,
buy.
that's just more like additional upside if they convert to floating.
Right, right. Okay. All right. So good. So a positive outlook on that piece of the securities portfolio for banks and an opportunity for investors. Ian, was there anything else about prefers before we go on to commercial real estate?
No, I think that's about it.
Okay,
One actually question for the investors that are watching. Obviously you can buy preferreds individually on the exchanges, or ETFs, and there's some closed ends. Any helpful hints for the investors who want to get involved in preferred stocks, and even in bank preferred stocks? Are there some nuances there when people are trying to buy them?
Well, we would definitely recommend doing the listed $25 preferreds. There are some preferreds that are $1,000 preferreds, but a lot of them are actually bonds. Those are very difficult to trade, and if you like call up a brokerage firm, they have dollar bid-ask spreads. But the New York Stock Exchange, usually it's about 20 cents. Now, to be fair, $25, so it's not that different. So it's important when you're buying preferreds, if you're not going to buy a fund, to try to split the bid-ask spread. So you have to be pretty patient when you're trading them so that you don't overpay. And that's an advantage of ETFs. Like our main fund trades like 200,000 shares a day and has pretty low bid-ask spread. So ironically, the bid-ask spread of the funds is lower than the preferreds. So what a lot of investors do is they might buy a fund, but then there's maybe a few preferreds they really, really like. And so you get a diversified portfolio, but then a little bit of focus on something that you know a little bit better.
Great, thanks. So we can move on to, in our time, you do a lot with REITs. You're very familiar with commercial real estate, and that's also front of mind for bank investors. So let's get your take on commercial real estate these days.
Well, we're more optimistic about it than most, particularly the media. And there's a simple reason for that. I mean, I think the analogy and why everybody's so focused on it is they're thinking that we're in the Great Recession or financial crisis. But there's a huge, as your listeners know, but there's a huge distinction between residential real estate and commercial in that it's very, very low cost. Sometimes it's just a bargain purchase option when there's a default, like you can buy the property at $1. So the cost of foreclosure is very low compared to the value of the asset. And then REITs are an important player in this market. And what most lay investors or investors who aren't bank officers don't understand is that REITs are extremely well capitalized. They usually are investment grade. They usually about 40% levered, whereas a building's 70. So, and if a REIT owns a building, and maybe it's a little bit underwater, they still might inject equity because they can issue equity in bonds and preferreds for that matter. And so when you really think about the actual losses, you have to take the overall pool. Office is going to be the worst. But then many of those offices, the sponsors are well capitalized. They're not like individuals who have low FICO scores like during the great financial crisis. They didn't have any money to pay down their mortgage. But the commercial real estate investors, particularly in this cycle versus in the past, are typically extremely well capitalized. It might be Blackstone, it might be a REIT, wealthy, billionaire private investor. So you're going to get a lot of injection of cash to buy option value. Put a little bit of cash, get the bank or other lender to extend. So we think that, that'll take a big portion of the defaults out. Well, some are just, way in the money. So those will roll over one way or another. Others, there'll be some injection of cash and extension. Then there'll be some defaults. So like, let's say 20% is office of the office, 20% defaults. So you're down to 4%, and then maybe if the recovery is 50%, you're down to a 2% loss. Well, most banks and other financial institutions have credit reserves that are close to 2%. So we're not saying there's not going to be any losses and maybe some additions to reserves, but we don't see the math that turns this into a true, macro event that's worthy of all the press it's gotten.
I think that's, reassuring to hear. The REITs that own a lot of the urban office, are they in there with?
Speaking of, and Carissa.
Are they in
I
there
just-
with?
Sorry.
I think we have a bad connection. Sorry. Can you hear me okay, Jay?
Yes, I can.
Okay, I'll go ahead and ask my question, and then Ian, you can ask yours. So are the REITs in the same urban office properties as regional banks are? Do they own the same properties, or?
The REITs tend to be, not all, but they tend to be more in larger buildings, more in urban centers, which might sound kind of terrible, but at least in New York and true of most of the country, A buildings, which they tend to favor, because they're larger and they're more prestigious and they need to, present a strong, a positive investment profile to the public. So they tend to own A office space, and it also tends to be newer. Most REITs are developers as well. And so what they'll do is they'll sell off their older buildings and then develop new buildings. And the other thing about the larger REITs like Boston Properties, Kilroy, not really true for NATO, they actually have a pretty substantial exposure to life science. And life science is no work from home in life science. You can't do vaccines in your bathtub. And number one. And number two, the demand continues to be strong for office because you have an aging of the population and continued pretty rapid drug development. So we think that those companies are undervalued. Their preferreds are particularly undervalued because people have just take this notion that there's weakness in office and then just assume it's every office, every building. And a lot of REITs don't have leverage on some of their buildings. So, but that's good. Even if you're just more focused on banks, it's important to note that you have these very well capitalized REITs. Like a lot of them are A credits, like, office is clearly under pressure, but if there's a problem with apartments, Mid-American Apartments, I know pretty well, is an A credit. They're about 20% levered. Most residential real estate, 70, 80. So they have tons of firepower to go buy. If there is a problem and a bank repossesses a apartment building, in fact, one just quickly traded, got repossessed and sold off to an investor right away. There's a lot of liquidity that the REITs provide because of their diverse access to capital.
Right. I was going to ask about the deal that PacWest seemingly did with Kennedy Wilson, and wanted to see if you had any thoughts about that, or whether you think this might be something that may be typical where banks have a buyer in REITs to offload properties they don't want or loans they don't want.
Well, right, because what's the reason that First Republic failed is that they didn't have enough assets they could sell off. But if you have a decline in deposits, you don't really want to go borrow money at 6% from the Fed, because you're going to lock in a bad spread. So most of the smaller banks, that particularly ones under attack by hedge funds, are going to look to sell assets. They did sell off a real estate portfolio as well as a mortgage, more of a mortgage origination. So you are going to see that come out, and that's going to hurt valuations, but it also might get the hedge funds to back off over shorting these companies and trying to attack them, which should be illegal, but is rarely enforced. The SEC's, it's sometimes challenged to go do enforcement actions on that. But they've been asked to by the Bankers Association. So I think that combination of the banks adjusting now that they have a little breathing room, and you know, a little bit more regulatory oversight on trying to induce bank runs should allow the pressure to slowly alleviate on the smaller banks.
Any other questions you might have, Julianne?
No, I think that's good perspective. And actually, I think you alluded to this, but just to clarify, if regional banks, like PacWest, do need to sell portfolios of office real estate, it sounds like the REITs, their stock prices notwithstanding, are in a position to purchase those. Is that right?
Yeah, no, I mean, not every single, I mean, the office REITs are most challenged, but in the sort of our pushback is this sort of a notion that all commercial real estate is the same. And so people are just saying, okay, here's a bank and they've got this exposure to commercial real estate. It's all bad and it's going to zero. But clearly there's such a deep bid for you have to distinguish about what sector. There's a huge bid for residential. There is a discounted bid for office. So we will clear at a price, but like a Vornado initiated a share repurchase because their stock's at 14 and it was at 100 2 or 3 years ago. So are they necessarily going to buy a new building? Or, I mean, not a new building, but a distressed building? Not so sure, but I do think there's buyers. There's been transactions in California. So the recovery value is not zero even for office. But our real insight is don't take all the commercial real estate. You really have to go building by building. And, really most of the distress is going to be in the office sector.
Right. And within the office sector, do you distinguish between urban or downtown versus suburban?
It's sort of a building by building situation. People think New York's terrible. It is terrible for B and C buildings. It's pretty good for new A buildings, like A+ buildings. It's actually very strong. But if you look at San Francisco, downtown is horrifically bad because of the security issue. But in my hometown in Palo Alto, particularly with this AI boom unfolding, my guesses would be that rents would be rising and occupancy, quite tight because there's going to be a lot of capital flow there. So that's kind of our really main insight is don't listen to the media. Just like, let's talk about, submarkets and buildings and how much leverage and how long is the lease profile. Because maybe you have a terribly challenged building, but the leases aren't up for an average of 8 years. 8 years, we're not going to have a lot of office building. It's going to absorb a lot of the, vacancy. So with the lease, every building is different with the lease profile. So we just think that it's way over capitalized, way over publicized. And let's wait for the banks to report, and they'll add some to reserves and there'll be some non-accruals, but we just don't think they're going to be like they were during the residential real estate crisis.
Sounds good to me. All right, Ian, is there anything?
No, okay, we really appreciate the time and your insights. We'll be posting your information about your funds, the presentation we've shown here. And any questions you might have, we'll provide an email to Jay's associate, Craig Starr, who will forward them on and we can get some answers to that. But again, thanks, Jay, for your help. And we look forward to our next interview upcoming. So for all of you investors and bankers, stay tuned. Thank you.
Thank you.